Today's session would be on corporate actions. See, if you try to reconnect with the last session, we had a discussion around buy side institution, sell side institution. Correct? Am I right? So buy side we discussed about like asset management companies where the mutual fund was there, the hedge fund, private equity, venture capital, all they were part of the buy side and sell side, like investment banks and even issuers who actually issue the securities in the market and raise capital, right? So those institutions were at the sell side who actually sell the securities to the investors and raise capital. Am I right? So if you want to understand, guys, corporate action part, so you will have to make sure that this part basically linked with all the participants. All participant, it means buy side, sell side, IBs, banks, even issuers. The reason is corporate action, it means nothing but it's an event. So if you read the text, any event initiated by the company to which may or may not have impact on shareholders equity, right? So that all events or activities we can call it as a corporate actions. Sometime you might see impact, sometime you will not see impact, and that's absolutely fine, which is not mandate. For example, let's say you have invested in TCS securities. TCS has decided to change the name. So name change, which again still comes under corporate action, but that doesn't have any impact on share value, right? So you can't see any, let's say, you can't see any change in stock price in the market. Am I right? Same thing if I talk about, let's say, Zomato company board was decided to change the name of a company from Zomato to Eternal something, and they have changed it. But have you seen any negative or positive impact of Zomato share price because of name change? I'm sure no. Correct? So same way, if I talk about, let's say, address change, if company want to change the address, or if company want to, let's say, uh, you know change the location of the base location or office, so you will not see any impact on share price. So those events you can call it as a the events without any impact on shares holding. Same way, if I talk about, let's say, annual general meeting of a companies, can you see any impact on your investment? Let's say you invested in Ambani, the company, and the board decided to schedule a meet with investors to brief them about business update. You may see the impact in the share price in the market due to speculation, because in a market you can see participants like trader, buyer, or there are lots of other participants who actually manipulate the market on the basis of market news, market masala. Could be, let's say, if Reliance Group issues notification in the public that we are meeting next week to take any, let's say, kind of bold decisions. So speculator can speculate, maybe Ambani can announce this project or that project, and they enter into future contracts, and that lead to the price change in the market. But that doesn't mean it will change the price of securities from the company side, and that is something speculations which is not in anybody's control. So speculations and corporate actions which has no relationship directly, indirectly you might have. I hope you get it. But if you see any questions around like, hey, do you know corporate action? So you should tell, yeah, I know it. Corporate action means any event. It could be any means any event initiated by the company to which may or may not have impact on shareholders' equity, and that all events or activities we can call it as corporate actions. And when we say activities or events, so I'm talking about from IPO to business closing or termination of business operations. So that during that, let's say, life cycle, if you see any activities, any means any activities, if that comes in business life, so that all activities we can call it as a corporate action events. For example, IPO, initial public offering, income distribution, merger and acquisition or buyback, then stock split or stock dividends, business closing, it means bankruptcy or liquidation of shares or delisting of securities. So that all comes under corporate actions. I hope you get it, what I meant to say, right? So these are the events. Okay, so now if I talk about, let's say, IPO, so let's try to decode the one by one event, and then you can means there are some technical things which I would like to decode that part as well, like in terms of maybe in company's book what happened, in investors book what happened, pre corporate action, post corporate actions. We'll have to discuss everything in details to to understand this corporate action part in details. Okay, see, if I talk about IPO, as we know, we have discussed lots of things about IPO. IPO, it means fundraising activity, right? So in a fundraising activity, what happened? Anybody can guess, guys? Company sell shares, company receive cash, correct? And investors receive shares. See, when investor receives shares, see on this part continuously, you might see the impact of corporate actions on this holding, because this investor receives shares, so this shares will call it as a holding. Basically, holding, it means investors have purchased securities in a company through an IPO, and they have holded the shares in the, or held the shares in demat account, you can say. So it means shares are held in the demat account of investors. All right, now see, on the basis of demat account holding, investors will receive benefit of corporate actions, and on the basis of the securities which are outstanding in the market. Outstanding, it means the investors which are holding the securities of, let's say, XYZ company, so company will basically calculate the corporate action benefits on the basis of that only. I hope you get it. So I'll decode that part through an example as well. But at this stage, just try to understand. So when we talk about events, what it means exactly. All right. So now, if I talk about, let's say, the dividends or income distributions. See, when we say income distribution, it means we're talking about cash dividend. So cash dividend is nothing but company distribute profit. right? As a company distribute profit as a dividend, correct? Then what happened exactly? See, company you can see the change in company's capital or company's cash, I would say, right? Why? Because when company process dividend, when companies process dividend, change in company's cash, and you can see investor receive cash, okay, on their investment. So this is how activity happen when we talk about income distribution. See, when company can schedule an IPO, we have discussed that when company is looking for additional capital, maybe to expand business operations or to scale the business to the next level, or maybe to acquire, let's say, XYZ business or repay the debt. In that all circumstances, company can schedule an IPO and raise capital from the investors. Apart from IPO, company can also schedule follow on offering as well, like right distribution. I would say right distribution, it means company can schedule rights and issue that rights to the existing shareholders to raise additional capital from the existing shareholders, okay. And if I talk about income distribution is all about company, if the, let's say, if company has earned any profit during the financial year, then company will distribute that profit to the shareholders as a dividend, okay. And when we say activity, it means what will happen at the end. You can see change in company's cash, because cash will reduce and investors receive cash amount as a income, right? So dividend is nothing but it's an income for investors, and this will receive on the basis of holdings, okay. Now, if I talk about, let's say, merger and acquisition, as we know, merger and acquisition is nothing but, let's say, any company want to acquire any other business line, correct? So that activity we can call it as a merger and acquisition. But merger acquisition, technically these are two different activities. Merger, it means, let's say, A company and B company, maybe from same business line, or maybe different business line, if they want to come together and marry or tie a knot with each other with, let's say, their capital proportion, or see, merger, there are types of mergers. They can merge their business, entire business, they can merge only capital, they can merge only resources, they can merge only business model, they can merge only the XYZ department, they can merge only resources. There are lots of types of mergers which you can see. But in short, if we talk about merger, it means two businesses can come together, like Maruti and Suzuki or Hero Honda, right? So this was the means merger basically. Merge, it means they just come together and work together in the market, because the main purpose was to capture the market and take care of the end-to-end business operation. So that business activity, you can call it as a merger basically. But from us, from the corporate action perspective, so you see that event we can call it as a merger, but see how that merger impact on per share price, that is also important, because after the merger you can see securities, the outstanding securities number will change, face value will change, then security price in the actual market, it may change due to the recalculation of an outstanding securities. If the two companies come together, then definitely, let's say, A company contributed 100 rupees, B company contributed 100 rupees. A company has a different investors, B company has a different investors. So now once both the companies come together, so capital will be 200 rupees and investor base will be double, right? But to allocate the shares to the investors as per the investment, let's say, ratio, it is very essential to recalculate the share price and even number of units, so that they can equally distribute to the investors on the basis of their pre-corporate action capital. I hope now you get it. And if I talk about buyback, buyback is nothing but every company has certain rights to repurchase the shares from the existing investors. For example, let's say TCS can repurchase the shares of his investors. Why? Because of two reasons. One, to control the market, the stake, so that they can stabilize the security prices in the market. If investors, let's say, means competitors of TCS, if they tender the securities in the market, and if investors participate in the tender, uh, it could be difficult for a TCS to control the the business activity, and it's a risk. So that's how company, instead of some time distributing cash dividends, company can look for a buyback, so that they can reduce the outstanding shares from the market, and take the control on equities which is available in the market in a huge quantity. Now, if you ask me, sir, if I compare income distribution and buyback, technically in both the cases, investor is getting money back from the company, right? And both the events, see, even if I talk about buyback, if there is no profit, then company cannot schedule a buyback event. So how company will repurchase it? You tell me. So it means only profitable business can look for a buyback of securities or income distribution. See, every time if company schedule a let's say cash dividend, again, which is not a good for the business. So company should have to have a strategic plan about distribution or buyback of securities. I would prefer, if I distribute, let's say, dividend, you know once in, maybe, let's say, if I talk about 2 to 3 years, in every 2 to 3 years, if my business is profitable, then I would prefer to go for buyback. So it means I'll buy back securities from the market, and try to control the holdings as much as I can. That's how I'll do it personally, if you ask me. Okay. But on other hand, again, if there is no profit, then businesses, they cannot schedule buyback event. So now, if you ask me as an entrepreneur, or let's say, if you're curious to know which one is good for an investment purpose, see, if I talk about buyback, the number of shares will reduce. Means whatever number of shares that you have, definitely company will purchase the number of shares from you. So you will lose the ownership of those shares. So with immediate effect. So it means immediately, definitely you would see the impact on number of shares. So number of shares will goes down. The reason is company has purchased your securities back. That is one thing. Second, if I talk about, let's say, overall impact, how you would, means, see, you have sold the one quantity to the company now through buyback, but you have other quantities as well outstanding. Then what would be the impact on outstanding securities? See, for a short term, you might see negative impact due to the cash movement. The reason is, if company utilize the cash which is available in account for a buyback purpose, so it means the balance sheet size will be reduced. You get it, my point? And that's how you may see impact on companies, the share price as well in near term, but for a longer term would be good, for the investors who is still holding the shares in the account of that particular company. The reason is, you may see there would be slight change in volatility. The supply of shares, of course, will be impacted, and the same again, if the demand, let's say, continues on because of buyback, right? Then you might see positive change in stock price, and you may see good positive return on investment as well. And same for dividends as well. If company, let's say, continuously, they maintain the healthy dividend yield, again, which is a good for an investor, so that they can reinvest the dividend amount, earn dividend amount in different uh, you know stocks, and make a make a good amount of money as well out of it. So that's how basically, guys, see, each and every activity has certain points, right? Technical points, so we should understand it. And if I talk about acquisition, acquisition is nothing but, if let's say any business want to acquire any targeted company, could be for the strategic purpose. For example, let's say Zomato and supply chain company. If Zomato tomorrow look for any supply chain company and acquire that company, just to streamline the business model, like they don't want to depend on the supply chain. It means the company which is in supply chain and providing support to them to supply the services to the end customer. That is a one. Second, it could be, let's say, in a cloud kitchens. So Zomato don't want to rely on only the retail restaurants because of quality and health concern. Maybe Zomato can start their own own cloud kitchen, so that they can maintain highest level of the food security, safety, and follow the standards, and sell out the foods in the market through their application. See, if the Zomato do that and acquire the bottom line companies which comes under their business model, then that the business or event, you can call it as an acquisition. So it means, and again, those companies will be mapped under Zomato only. So Zomato has acquired the company. An acquisition definitely would be through, could be equity, or could be directly that 100% equities will purchased, and that business will need, again, the new business uh, means Zomato can change the name, and wholly the business would be like Zomato Holding Company. You get it, my point? So that's how the acquisition works. But when we talk about, see, process perspective, how that uh, that works in this corporate action process. See, for us, the important is how this merger and acquisition move impact on shareholders' wealth. Second thing, what actually happened if acquisition happened. So let's talk about the one by one. In merger, right, A and B company come together and form AB firm. So it means new shares will be issued, okay, to the shareholders, and existing shares uh, will be taken back, right? Because see, before this activity, definitely you would see, let's say you are the investor who had invested in A company and I had invested in B. So it means we'll both will have to surrender shares, correct? And the company will issue, means both A and B, means AB firm will issue the new shares in the market with the name of AB company. All right. Then if I talk about acquisition, so in an acquisition, what's happened? Let's say A company want to acquire to the B, right? So what happened to the next? A company, acquire B, but the name of A company, you might remain like A in the market, And in this acquisition case, company doesn't require to really change the name and everything. The reason is it's just acquisition. It means it's a purchase where company has purchased securities. Okay. So in case of acquisition, exist means invest. You see the investors will not receive any new shares or anything as such. So the outstanding shares you might see would be same. No impact on outstanding shares. But in merger case, definitely you would see impact on outstanding, because the number of outstanding shares will change. Yes. In terms of investors, the invested value, see that impact basically we can analysis after the merger acquisition or merger and acquisition. So that is something I would say it depends. Sometime you might see negative impact, sometime you might see positive impact as well, because see how the market will react nobody knows, and that only you can experience after the event, right? See, sometime it could be good move, sometime it could be bad. For example, let's say Atos company was the one of the the big company in the market, in France market basically. But when the Atos acquired Sintel, which was technology company, Sintel was a debt burden company, was struggling to pay the debts and everything. So Atos acquired to the Sintel. It was an acquisition, and finally what happened through acquisition? So now Atos went on a bankruptcy. So this is how things happened. So that depends. So how investors look at to that model, which is a very different thing, because see investors analysis model and they try to understand, if let's say A and B come together, then what will be the impact on revenue, what will be the impact on market, how company will take care of the resources, how company will try to produce the good return from utilizing resources, right? So that all factors will be checked and verified, and then only you can see the investors, the cognizant investors will take the investment decision. Maybe they can directly take exit from the company, or maybe they'll continue to it. But retail investors, they don't really care about it, because they don't know what is merger, what is acquisition, and how does that impact on the investments holding. So we don't even check it. You get it, my point? But you should know it as a student. So what exactly happened here? And then if I talk about stock split, see stock split, it means is nothing but it's just like the company let's say split the outstanding shares. Outstanding shares. So your question would be, sir, why company change their outstanding shares? Company change it because of two reasons. One, let's take example of MRF. MRF stock price, which is at the current stock price, let me just check it, I think, which is because when I last time checked it, MRF share price, okay, 1,34,000. So think at a very the practical side, will you as an investor, retail investors, will you be able to purchase MRF 1 shares? Let's say your appetite is 1000 rupees, 2000 rupees, 5000 rupees. So will you be able to purchase MRF stock price? Your your answer would be no, sir. Why? Because the MRF share price, which is at a very highest side, and as a retail investor, I cannot buy. Nice. Then, sir, what is the solution to this? See, there are two ways. One, in India, we are not allowed to buy the shares in fraction. Fraction, it means even if you have 100 rupees, you can purchase the mutual MRF shares of 100 rupees. So that is what we'll call it as a fraction. So in India, we don't have that facility, but in US, fractions of shares, the purchase which is available. Now I do investment in in the US market, so I purchase certain, means I am holding some certain securities. See, even my capacity is not to purchase securities, crores of rupees securities. No, I'm a small investor, but I do invest in US stock market and purchase the equities in fractions. For example, let's say Google. I cannot spend 1000 rupees, $1,000 at a time to purchase, the Google shares. But I can spend $100 or $200 to purchase half the shares of the Google or Meta or any of the securities, Microsoft or Apple, right? But in India, so see, if company want to make shares, let's say affordable, it means not in terms of valuation, in terms of stock price. If the company, let's say, want some retail investors or want to increase the retail investors participation, then company can look for a stock split, right? So stock split, in a stock split, what happened? Number of outstanding stock split. So what happened in a stock split? Number of shares increase, and you might see the the events like reverse split as well. So in a reverse split, what happened? Number of shares decrease. All right. So this is how things works. If I talk about, guys, stock split, and same thing happened in the books of company as well as in the books of investors. Now your question would be, sir, if number of securities change or reduce, definitely there would be impact on my investment. My investment value may go down, my investment value may go up. No, the answer is no. Your investment value in terms of the money would be remain same. Then what will change? See, you may see change in the basically the number of shares which are held in the demat account. Maybe previously there were 100 shares, company decided to multiply with 10, so 100 into 10 would be 1000. So the thousands new securities will be credited to your accounts, and existing the 100 securities will be removed, and the new securities price, definitely it would be changed from, maybe let's say initially it was 100, and post stock split price would be maybe 10 rupees for per shares. So this is how things works. And if I talk about stock dividend, see, instead of cash dividend, sometime company can they issue the stock dividends to the investors, means additional stock will receive like a bonus. And that, but if you see technically what it means, company want to utilize earned profit. Maybe it could be for, let's say, working capital purpose, or maybe want to spend on something. So company can convert profits into the capital. So when company want to convert profit into capital, so at that time company will have to increase the number of outstanding shares and issue the shares to the investors. For a stock dividends or bonus issues, investors they'll not pay single penny to the company, but company will directly credit that shares to the investors account. And due to the stock dividends or stock split or even bonus issues, see, in most cases there won't be any impact on investment value, but you might see impact on number of shares which are held in the demat account. In case of bonus, number of shares will increase. In case of stock dividend, number of shares will increase. In case of stock split, number of shares will increase. In case of reverse split, number of shares will decrease. So you might see that impact. Okay, but you cannot see the impact on the outstanding, sorry, you cannot see impact on the total investment value. I'll take a couple of examples when we say value or impact, how does it look like. Don't worry. Okay, then the another thing which you can see, which is business closing. So business closing, it means bankruptcy, where if the businesses are facing any liquidity issue or if they don't have a capital to operate business activities, then businesses will go for bankruptcy. So in a bankruptcy, what happened, company can liquidate all assets and delist the shares from the market. So it means securities will be directly removed from the investor's account. Company can directly remove it. So that activity we can call it as a the business closing part, because business now don't want to operate further and shut down the operations. So basically these are the major activities, but on the ground you might see thousands of there will be activities or actions, and those come into the picture. But at this level, at your level, which is not required technical discussion, and I don't want to spend much time on the technical side, because in a technical, see, to discuss corporate action in details, we need at least 6 to 7 months. That's how this corporate action is, because at the operation level you can see lots of things will be there. Lots of means lots of, but we don't require it at all right? But yeah, so these are the, I think, broad categories, I would say, which comes under corporate action events. But from the the types or side, or what, like, see, definitely you may see questions around like what are the different types of corporate action events. And when we talk about types, there are different types, but same, these are the broad categories. So broad categories, when you classify to the different types, right, that could be your mandatory corporate actions or voluntary or mandatory with choice. See, if I talk about merger, acquisition, buyback, that comes under basically, and even IPO. See, capital raising related activities, in most cases that comes under voluntary. So company cannot force to participate in any capital raising activities, right? So company cannot force. Would be voluntary one to the investors, if they are really interested or if they have a trust on business or leadership, they can contribute capital, otherwise they can't. In IPO also, what happened, company only requests to participate, but they cannot force to participate and pay the capital. That's how you can differentiate. So most of the, I would say, the capital raising activities that comes under the voluntary corporate actions. And if I talk about income distribution, stock split, stock dividends, and business closing like bankruptcy, all are mandatory actions where investors can't decide anything on it. If company decided to distribute dividend, then company will distribute it. If let's say company decide to go for a stock split, the company's, the CEO or board of directors, they can simply put a proposal in place that they want to go for a stock split, and stock split will be processed out. So it means they don't really require permission of shareholders. But for merger and acquisition buyback, definitely they need a proposal from the shareholders whether they can go for a buyback, or whether they can go for a merger and acquisition. So they'll have to discuss everything with shareholders in terms of profit position, and then only they can take a further decisions. I hope you get it what it means. So if I now talk about what are the different types of corporate actions, so you should tell them there are two types of corporate actions. One is mandatory and another one is voluntary. So most of the capital raising, the base events which are part of voluntary events. So it means company cannot force to anybody to participate in capital raising activities. So it would be voluntary on investors to participate or not. And if I talk about, let's say, the mandatory one. So in terms of mandatory, the stock split, dividend, business closing or delisting of securities, income distribution, that all comes under mandatory corporate action events. Note down somewhere. I know that would be difficult to keep in mind everything, but you can note it down. Okay, so these were the types of corporate actions. So let me try to chart it out if I can quickly. Types of actions. There are two types. Mandatory and voluntary. All right. So if I talk about mandatory, we have already discussed, but let me just categorize it. So if I talk about mandatory, in a mandatory, your action should be like, let's say, name change, stock split, reverse split, and then sometime merger and acquisition also comes under mandatory as well as voluntary. So depends on the situation. Cash dividend, bonus, stock dividend, and bankruptcy. So all events comes under mandatory. And under voluntary, tender offer, buyback, rights, IPO, even merger and acquisition. So investor can take a decision, and take a exit out of it. So all are the events which comes under voluntary events. So what it means in short, if you ask me, in a mandatory events, company board take a decision and announce event in the AGM, so that decision basically action will be implied on all security holders. Okay, here company again board, instead of decision I would say company board announce event in AGMs, so that investors will decide on what to do next, whether they want to continue with company or not, whether they want to invest or not. They'll take the decision. Simple. So in a IB, if someone asks questions on, let's say, hey, what are the different types of corporate action, so you should tell them, look, there are two types of corporate action. One is mandatory, another one is voluntary. Mandatory, it means company board take a decision and announce event in the AGM, and that action will be implied on all security holders. If I talk about voluntary, in a voluntary events, what happen in the voluntary event, company announce, board announce, but that decision would kind of, they just announce it. Further, investors will decide what to do next, whether they want to continue or not. So they'll decide it. Okay, so this is how company basically take or schedule the corporate actions. And there's, if you ask me, sir, what are they? See, these are the broad category, the categories why company announce corporate actions. Company announce corporate actions because of an IPO. Company announce corporate action because of income distribution. Company announce corporate action because of merger, acquisition, or if they want to communicate something to investors, then company schedule corporate actions. Okay, so I hope now you get it. But again, the most important question here would be, look, as an investor or as a company, if I want to take a benefit of corporate actions, would there be any let's say rule that we need to follow? Of course there would be rule that we need to follow, and if you don't follow that rules, then you cannot take the benefit of it. For example, let's say IPO. In an IPO event, what happened? Company announce event, right? So from announcement date, you can track the company's IPO, and company also schedule offer date as well, right? Open offer date and closing offer date, correct? And then company also schedule book closing date as well. So it means what will happen, company first schedule the offer date. So during that offer date, company accept an application from the investors. If they are interested, they participate. If they are not, that's fine. And if company has received, let's say, certain applications, then company review it, and then after review, company take a decision basically, whom they want to sell the securities, and they sell the securities, correct? So this is very important to understand the pattern. Okay, so now if I talk about let's say if I talk about stock split or bonus issue, company has announced bonus issue, ABCD, XYZ, any company, and you want the bonus, shares in your demat account. See, there are two things. One, you are already holding the shares of that ABCD company, then you don't need to worry about, just don't sell the shares, right, until you reach to the record date. So on record date, maybe you can sell the securities from the, from your accounts, and that's absolutely fine. Company will still capture, your data, and seller, it means if you, even if you sell the securities of a company in the market, still you will get the benefit of bonus issues. That is one thing. Second, if let's say you are not holding the security of any you are not holding security of ABC company, but still you want the benefit of corporate action, then in that case what you can do, see, in that case what happened, so you will have to basically, you will have to basically, you know buy the securities from the stock exchange before an ex date, right, and you should hold the securities in your demat account. So throughout this, the date cycle, means record date cycle, and then after only you will receive the benefit of the corporate actions. So still, I'm sure you would be confused, but I'll now, let's say, put it in this table so that you can understand it, how things looks like. Let's say company announce, ABC company announced here bonus issue. Okay, so in announcement, company said for one shares we are going to process one bonus issue, which is free of cost. Let's say a investor, so a investor holding 10 shares in demat account. Okay, so now if I talk about announcement date, let's say this was announced on 25th 4 2025. Okay, then you can see company will set the entitlement date. It means the last trading date of this particular security. But who set this? Stock exchange set the date. Okay, so stock exchange can set the date, like first, once the company announce the date, company also announce, means here company announce two things. One is the what they are offering to the investors, and second one is record date. And company, let's say, decided to announce record date like 2nd May. May 2025. So same record date would be here. So company announced it. So once the company announced recorded, then company send the details to the CB and even exchange, stating that we have decided to offer 1:1 bonus shares. And with regards to this, we just want to notify to the stock exchange. So please notify to the all participants that their securities will be changed on and after the record date of 2nd May 2025, because as 22nd May, and definitely they'll include time as well. Time stamping is also important. Maybe let's say 10 a.m. or 9:15. So 9:15 a.m. IST will be the time stamping and last deadline to close this book. Before that, if we captured any securities in the books of a, let's say, company, then only those shareholders will be entitled to get the benefit of corporate actions or bonus issue. That's how company will send a notice to the stock exchange. And then immediately, guys, stock exchange will announce the ex date. Ex date, it means expiry of dividend date or expiry of corporate action, benefit date. So it means, let's say this bonus issue will expire on 2nd May. So what it means, company means, see, the stock exchange will notify to the all shareholders, do not purchase any securities on X date. Listen this very carefully. So stock exchange will notify to the all shareholders and ask, do not purchase any securities on X date if you want to take the benefit of corporate action. Then your question would be, sir, on which date as an investor can buy the securities to opt, the benefit of this bonus issue? You can purchase securities on entitlement date, or I would say before an X date. So it could be your entitlement date. So entitlement date, which is nothing but it's a trade date. So as an investor, you should purchase securities before the X date and you should hold securities on X date. See, technically, if you see now, the X date and record date both are same. If you purchase the securities on entitlement date, that security will settle in your account on X date, because we have now T+1, right? So it means basically entitlement date would be trade date and X date would be your settlement date. So make sure that whenever you want to take the benefit of corporate action, you should purchase the security on entitlement date, and that security you should hold, or maybe let's say ensure that has been settled in your account on X date. Then only you will get the benefit of corporate action. I hope you get it. So let me just put it as a bullet point so that you can understand. Okay, so trade date, so you can call it entitlement date would be your trade date. So investor should buy shares on So investor should buy shares on trade date, entitlement date, because entitlement date you can also call it as the trade date as well. But the same shares, guys, it should settle on the X date. Shares should settle on X date or before X date. That's the condition of the benefit, if you want the benefit of corporate actions. I hope you get it, right? And the rule, even corporate action, says like, if you want the benefit of corporate action, you should make sure that you should hold or buy the securities before an X date, and securities should settle in your account on X date. Then only you'll get the benefit of corporate actions. And record date is nothing but, the record date is the book close date. Book close date, where company process the the benefits as per the record date. Let me tell you something. See, company set the record date. Set the record date. And who set the ex date? The exchange set the ex date. So that's how you can differentiate. And what about payment date? So if, let's say, if you hold the securities on means if you hold the securities on the ex date, then company process the payments, or stock payment could be cash payment to you on payment date. So that's how you can see the importance of dates in corporate action. So as an investor, if you want to take a benefit of corporate action, so make sure that you're buying securities before an ex date, and you can hold securities on record date. You might see question around what if, let's say, if I sell the securities on X date, what will happen? If you sell the securities on X date, then benefit will receive to the seller only, because it will take 1 day to settle. It means X date plus 1 would be the the recorded plus 1. So on recorded plus 1, if security settle in the buyer's account, so it means still the security would be in the account of seller, so seller will receive the benefit of corporate actions. So you should avoid buying securities on ex date of any scrip or any stocks. All right. So that's how corporate action works. There are lots of things in a corporate action, so that I would like to cover in coming time, along with some examples like how dividend calculations works, so merger, acquisition, dividend, stock dividend, bonus issues, and all of that. So be there, be connected with the session. I'll continue to discuss the same thing, about corporate action in details, and we'll decode this. All right. So thank you very much, guys, watching the session. We'll see you next episode. Thank you.